Thinking about this now, I've got my emergency monies, so money for sure that I need in the short term, next 36 months. I've got my cash wedge strategy, so maybe I've kept a certain amount of my long-term portfolio aside in cash to fund my retirement income. So now I can develop an investment policy statement for the remainder of my capital according to the growth or income needs of that account. So let's think of the major account types that you might have. You have a tax-free savings account, you have an RSP, you have a RIF if you're already converting your RSP into income, and you have money that's outside of registered accounts, what we call not registered or a cash account. So the TFSA, you would have a growth strategy. The more I can grow that money, the less tax I will pay on that growth. So if you wanted to hold your growth, in other words, your highest allocation to equities anywhere, the TFSA is the best place to do so. When I'm accumulating money before retirement, I'm using an RSP as an accumulation vehicle. So before retirement, I might have my RSP be 80% growth, 20% for income. As I get closer to retirement and I'm going to create a RIF, decumulation strategy, I might want to reduce that to make it look like a pension plan, like we just looked at, where I'm 60% growth, 40% income. We call that balance growth. And finally, in a non-registered portfolio, money held outside the RSP or the TFSA, a balanced growth portfolio works really well, 60% for growth, 40% for income, but the growth portion we want to focus on eligible Canadian dividends due to the tax treatment. Now that we know the TFSA is for growth, some of the portfolios that we use for our clients, we can start assigning to the different account types. So for example, TFSA, if I wanted a high growth strategy, I would allocate 100% to equities. We call that our perpetual model. The idea being that it's perpetually there for growth. An RSP, while I'm in accumulation, we call it pursuit. I am pursuing growth still, so 80% equities, 20% income. When I'm riffing, I'm creating a pension. That is our largest portfolio, most commonly used portfolio for clients. We call that our pension portfolio. 60% for growth, 40% for income, more like the pension plan. And then finally, in our non-registered portfolios, where we want to have tax efficiency of the income stream, so we're focusing on dividends and capital gains, we call that our dividend portfolio. So again, all of this sounds great. What if we go back to Mike Tyson? We get punched in the face. So what I always explain to clients is you should be investing today as if every day is the start of a calamitous turmoil in the markets that could last as long as 3 years. So I like to tell people, invest today like it's either the start of 2000, where we had 3 years and the dot-com bubble blew up, or the beginning of 2008. Okay? That way, you know what your worst case is going to be on the downside and how long you're going to have to wait till those investments come back. Remember, cash can be the winning asset allocation strategy for periods of up to 3 years, but it will not beat your portfolio over periods of 3 to 5 years. It's your emotional reaction to when cash is winning that matters. In other words, if my portfolio is down 20% and I sell it all to cash, I'm going to have a very bad losing strategy. So let's look at some of the data surrounding variability of the returns that we're looking at. Remember, asset allocation drives the variability, so let's talk about that. So a portfolio that's 40% for income and 60% growth, even investing from the worst possible times, your average return is going to be close to 5.2%. Now that doesn't tell the story, because when I say 5.2, you think 5.2, 5.2, 5.2, 5.2. Not true. In a year, you're going to lose money 30% of the time. I'll say that again. On a balanced portfolio, you're going to have a negative year almost 30% of the time. Over a 3-year period of time, historically, you're going to lose 15% of the time. Your chance of losing money over any 5-year rolling period of time in a balanced portfolio drops to as low as 5%. So in other words, over any rolling 5-year period of time, historically, 95% of the time, you're going to make money in a balanced portfolio. So that is how I want you to think about it. What's the chance that I'm going to be negative? So if I focus on the day, or if I look at my statement every month, in the last 24 months, variability has been 50% of the time monthly. That means half the time you looked at your statements at the end of every month, you would have seen a negative number. not as much negative as the markets if you're a balanced investor, but negative nonetheless. A 60% balanced growth portfolio, 60% equity, is going to have the same variability chances as the stock market. It's only going to get 60% of the downside. So I really want you to think that monthly, expect returns in your portfolio, not cash, but in any portfolio, to be negative up to half the time. So stop looking every month. Focus on your annual, your 3-year, your 5-year numbers. You've established your investment policy statement. That will then dictate the eggs that go in the basket. So back to our balanced portfolio that looks like a pension, 60% of the assets that are in that portfolio are going to be for growth. But this will include a number of different eggs in the basket. US companies, Canadian companies, global companies, mortgages, bonds, preferred shares, alternatives. You will hold all of these together in that diversified asset allocation strategy. If you're a growth investor, it simply means more of the underlying holdings that you have will be on the equity or growth side. We'll set up rules for rebalancing. And what that means is if we left your portfolio alone and we bought it one time and we kind of set and forget it, eventually your asset allocation would drift. So for example, if the equity markets do well, eventually you'll have a higher allocation to equities than you would to income, which meant you would be taking on more risk. So we will take your portfolio and set up a set of rules of how often we're rebalancing your portfolio. If equities go up, we will reduce the allocation back to your targets. If they go down, we will buy more. The reason these rules are so important is it takes your behavior out of the equation. If a portfolio is supposed to be 60% stocks and it goes up to 70% stocks, we will reduce your exposure to stocks back to 60%. We will generally be buying the asset in your portfolio that is down the most when we rebalance. Let me give you an example. Say you have a $100,000 portfolio that was rebalanced quarterly, and you started way back in 1992, and you were going to take out 5% of the total value of that portfolio every year. That's your distribution strategy, which would work out to about $417 a month. And say we index that to inflation, and we did that every single year going back to 1992. And we used a balanced growth investment policy like a pension, 60% stocks. So by the end of December 2022, that $100,000 paying out $417 a month indexed to inflation was still worth $87,000. Okay, think about that. You retired at 55, you're 85, and you still have 87% of your capital. Now, you would have gone through 2000 to 2003, 2008. You would have gone through the dot-com bubble. You would have gone through the housing crisis. You would have gone through COVID, and you would have gone through this last 2022 interest rate spike. The point is, you would still have 87% of your capital, and you would have drawn a regular pension from that in perpetuity. That's why a balanced growth portfolio works so well for retirees. The investor's chief problem and probably his own worst enemy is likely to be himself. And the man who said this was a guy by the name of Benjamin Graham. And you probably don't know who he is, but you do know who Warren Buffett is. And Warren Buffett was one of the disciples or students of Benjamin Graham, the founder of value investing. And people like Benjamin Graham and David Dodd and Phil Fisher helped people like Warren Buffett develop the tools to build his empire. The key thing is not reacting to emotion. And as we said at the beginning, like Buffett often parrots, is be greedy when others are fearful. What does that mean in practice? It means usually the asset classes that are being sold the most heavily is where one as an investor can find the most value. So back to my idea of rebalancing, generally you want to be buying the things that everybody else is selling and selling the things that everybody else is buying. What I often hear is, well, what if I lose all my money? The kind of portfolio that we're building, 80% equities, 60% equities, the kinds of companies that we will hold will generally never go to zero in value. If I buy shares of TD Bank, I will have variance in the price of the shares of TD Bank, but very little chance it will go to zero. Say you don't believe me? Well, we have another course. The prerequisites are on this slide that I'm showing you here. If everything is going to go to zero, what you essentially need is your, we'll call it your go bag, your zombie apocalypse preparedness kit. Prerequisites would be your 12 gauge, your fishing rod. And maybe you're thinking, well, that's not very funny. What if everything goes to zero? Well, then the portfolio management of your financial planning life is the least of your concern at that time. Do not invest in things you think can go to zero. We do not do that for our clients, nor would a pension plan. If you really think things are going to go to zero, build your zombie apocalypse preparedness kit. But for every other portfolio, it's what is the degree of variability that you can handle on a monthly, daily, or annual basis before you make a change that hurts your long-term financial plan. In summary, I hope I've given you a couple of key things to think about. Managing your emotions, write down your investment policy, stick to that investment policy, potentially have a different set of rules for the accounts that you have, rebalance, monitor it, and compare it to what's happening in the world. Do not focus on the short term being rolling periods of time under 36 months. Reach out to your advisor, reach out to your portfolio management team, reach out to us at Love Financial, and we can guide you through this variability. Thanks for listening.